Hello investors, welcome my channel Investment Research. I'm Simo, your equity research analyst, and today we are going to talk about how to invest in the stock market in a moment of crash. At some point, a stock market crash will happen. It's not a matter of if, but when. There's probably more talk about it now than I've heard for a couple of years, as lots of people are convinced that we are in a bubble. It could happen next week, next month, or even a few years from now. It could even happen when I post this video, and then I'll look like some kind of investing guru. I mean, I'll take it if I manage to get the timing right. Anyway, the point is that crashes in the stock market are just part of investing that we're all going to have to deal with. How we act and what we do during a stock market crash could have a huge impact on how much money we end up with. So with that said, here are 3 key things I think every investor needs to focus on. These are important whether you're just about to start out or you've been doing this for more decades than I have. But remember, you don't know where the next 1,000 is going to be. It could be down, it could be up, and it's futile to try and guess it. Okay, imagine this scenario for a moment. Your partner, other half, or best mate is arranging a surprise holiday for you. All the information you know is that you're leaving next week. You don't know where you're going or what you'll be doing, and you don't even know how long you'll be going for. It could be anything from a short weekend city break to a couple of weeks on safari. Now, how would you start to plan or pack for a trip like this? You might first try and be a bit clever about it. You could say to yourself, well, my partner loves beach holidays, and we've only ever been on those kinds together. I know they don't like to be cold, so it's probably going to be somewhere warm, maybe somewhere tropical, so I'd better start packing lots of shorts and t-shirts, including my snorkel. You could even be way more sneaky and do lots of investigating, as this is what investors are told to do. You could look over their shoulder to see if you can see any emails from holiday companies. You could check your shared bank account to see what airline you could be traveling on. You could even hack into their phone. Okay, maybe not that far, but you get the point. You could try and spend all the time you want making a guess before you start packing. Either way, you have to make a decision. Are you going to pack all your summer clothes and beach shorts with a couple of jumpers? Or will you decide this could actually be a ski trip, so you better make sure you bring your thermals and your gloves? It's a difficult decision because if you get it wrong, you could end up looking a bit lost. Take your pick, it's your decision to make. Now, investing is a bit like this. We basically get asked to pack our bags, so we're ready for the future. We know that if we get it right, we could end up having a great time, make lots of money, and retire early or achieve whatever goals we have. We also know that if we get it wrong, we could end up losing everything if we're not prepared. I don't think we'd survive a ski trip very long in a pair of Hawaiian shorts. I reckon an air ambulance would probably have to come and get us pretty quickly. There are plenty of people out there utterly convinced their partner has booked them a 2-week all-inclusive at their favorite resort. No question about it. So they just pack exactly what they think they'll need, all shorts, t-shirts, and even some dress pants for the evening. However, even in this perfect scenario, plenty of things can go wrong. At your destination, you could get a cold snap with freak flooding, or maybe even some snow. Your luggage could get lost, your coach transfer could be delayed, or even your hotel could burn down before you arrive. No matter what you think is right and how well you prepare, there can always be something outside of your control. And this is exactly why, with investing and anything else, it's important to remember that nobody knows the future. After the 2008 global financial crash, Jeremy Grantham, a very famous investor, proclaimed that the S&P 500 would be dead money for a decade. From 2009 until 2020, and arguably up until today, the the market went on one of its longest and strongest bull runs, compounding many times over. In 1997, Microsoft's CTO at the time said Apple is already dead. It ended up becoming the world's most valuable company and remains a giant today. And finally, the president of Michigan Savings Bank advised against investing in Ford back in 1903. He said the horse is here to stay, but the automobile is only a novelty. Cars replaced horses in less than 30 years. I could give you dozens more examples, but the point is simple. Nobody knows the future. It doesn't matter how intelligent you are, how many degrees you have, how many correct calls someone made in the past. Nobody knows what's going to happen next. If you just accept this and start from that position, it's a great first step to becoming a really good investor. And that leads to what I think is the single most important lesson. I believe 98 or 99%, maybe more, of people who invest should extensively diversify. If we can't know the future and we don't know exactly where we're going on this surprise holiday, what are we supposed to do? We don't want to do nothing, and we certainly don't want to miss out on a free holiday. So we better think fast, stay well diversified, and own lots of different kinds of investments. Sounds simple, but what does it actually mean in practice? If it was that easy, surely everyone would do it. In the holiday example, it means packing a suitcase that gives you options. So you'd have some beach shorts, swimming trunks, t-shirts, jumpers, a coat, and maybe a couple of layers of waterproofs as well. It might mean you don't have space to bring every outfit and you have to wear the same swim shorts a couple of days in a row, but in the event things go wrong, you can still enjoy the trip. For investors, it's the same. When we invest, we're planning for an uncertain future. We can do all the research we want, but the future is unknowable. So own a bit of everything, big companies based in the US, smaller companies in the UK, companies in China, parts of Africa, tech, healthcare, energy, defense, whatever makes sense. Own different asset types, stocks, bonds, maybe some cash, commodities, and real estate if you can. The point is, by owning many different things, you reduce your level of risk. Because during a crash, a whole sector can be wiped out. Imagine you went all in on a company like Nokia in its heyday. You might have done fine for a while until something bigger came along and knocked it off its perch. That's why diversification matters. Most investors get diversified by buying an index fund. The S&P 500 is the most famous, and on its own, it is a well-diversified investment. You own a slice of 500 large US companies, but for many investors, especially outside the US, that's not enough. The S&P leaves out many companies based in other countries, and it leaves you exposed to currency swings. For example, a UK investor who buys the S&P in pounds can have quite a different return to a US investor who buys in dollars. Over short periods, this can swing returns significantly. That's not a reason to try and time currencies, but it is another reason to consider owning global funds that include companies from many regions. There are a few more cold facts worth thinking about. Most companies that ever existed either failed or got acquired. Many publicly listed companies perform poorly in the long term. Between 1990 and 2018, only a very small percentage of companies accounted for the net gains of the entire market. That makes picking winners brutally hard. So diversification is like buying a seat on a plane of which only a tiny number will become unicorns. You don't need to find every unicorn. You just need to own the plane. Now, the last point, and maybe the hardest for people to accept, is this. Don't panic. Don't sell out in fear. There's an old saying, you should only invest what you can afford to lose. For me, that makes no sense because it implies a short-term gamble. The better rule is you should only invest what you can put away for a long time. Any money you choose to invest should be money you don't need for at least a few years. ideally decades. If you have to sell because you lost your job or you need cash, you'll likely be selling when prices are low and locking in losses. That's why an emergency fund is basic and essential before you start investing. Every time the market drops 5%, my social media lights up with messages. Should I sell now? Should I step to the sidelines? People panic and make terrible decisions based on headlines, numbers, and fear. They sell low and buy high. That's how wealth transfers from the fearful to the patient. Here's a simple mental model I use. Think of your investments like your house. Imagine every day a man comes to your door and offers to buy your house. Some days he's generous and his offer is too good to pass up. Other days he's in a foul mood and his offer is low. The house is the same. The only thing that changes is his offer price. But knowing that price every day would drive you mad. You would start imagining the house was worth less and less, and you might sell it at the worst possible time. That's what checking your portfolio obsessively does. It forces you to live in short-term price land, which is toxic for long-term investors. Bear markets, which are declines of 20% or more, have happened nearly 30 times since 1928. So roughly once every 5 years on average, expect them. They vary dramatically in length and depth, but history shows markets recover. It might take months, it might take years, but if you stay invested, you participate in that recovery. If you want actionable steps, here's what to do. Review what you own and make sure you understand it. If you own individual stocks, be honest about whether you can tolerate their volatility. If you can't, you probably shouldn't own them. Rebalance where necessary so your portfolio stays diversified. Keep cash or dry powder to take advantage of dips if you have the capacity and the temperament. Keep an emergency fund so you're not forced to sell in a downturn. And finally, set a plan. Stick to it. Most people fail not because the market was bad, but because their behavior was. Crashes are painful and they're loud. They make you question everything. But they are also when value gets created. They are when great businesses can be bought at unfair discounts. They are when patient, disciplined investors gain the edge over the crowd. So when the next crash hits, and it will, remember this. No one can predict the exact timing, but everyone can prepare. Keep diversified, own a bit of everything, don't panic, invest for the long term, and make sure you aren't forced to sell when things get ugly. That's how you survive and how you come out ahead. I'm Simo, Equity Research Analyst. Thanks for watching Investment Research. Stay patient, stay disciplined, and I'll see you in the next video.